Hello everyone, thanks for checking out my video. Well, small caps surge and big tech stumble. That's one liner to summarize what happened in the US stock market last week. As a result of the market rotation, S&P 500 and Nasdaq clocked their biggest weekly losses since April this year. The tech-heavy Nasdaq also snapped a 6-week winning streak. A look at the Magnificent 7 shows that they were all down last week, ranging from about 3.5% to close to 10%. Additionally, CrowdStrike, a cybersecurity technology firm, plummeted 11.1% last Friday following a largest IT outage in history that impacted businesses all around the world. With the big tech companies reporting their earnings these 2 weeks, things are getting really volatile. And oh, I stepped in last week for one particular stock, so do watch on this video to find out what that is and also what we can expect in the next 2 weeks. So, the S&P 500 and Nasdaq slipped 1.97% and 3.65% respectively last week. There was a clear dive in the tech industry, with AI-focused chip stocks bearing the brunt. To make things worse for the chips industry, there were news that President Biden could be set to further tighten restrictions on exports of semiconductor equipment to China. And then on Friday, investors assessed the impact of an unprecedented failure in computer systems that work with CrowdStrike and Microsoft-based platforms. This IT outage impacted lots of companies globally, including airlines, banks, hospitals, and media firms. Over the last 2 weeks, it has been quite evident that investors are rotating out of megacap tech giants into smaller cap companies, which many believe will benefit more from interest rate cuts. In short, last week, tech industry was under pressure due to market rotation. Chips companies were under pressure because of President Biden, and software companies Microsoft and CrowdStrike were under pressure because of the IT outage. Alright, moving on to this week, there will be a series of earnings reports coming up. Tesla and Alphabet, aka Google, will be the first of the Magnificent 7 to report earnings on Tuesday. For Tesla, investors will be very interested to find out more about the progress of their plans for robotaxis, as well as the usual stuff such as their revenue, profit margin, and delivery outlook for the rest of the year. As for Google, the market will delve into the details of their ad revenue and how much boost in their earnings they can get from artificial intelligence. Other big names that are reporting this week include Coca-Cola, Visa, General Electric, and Unilever. All these are companies with over $100 billion in market cap. Through their earnings, investors will want to get a glimpse of the state of the consumer and economy. As for most of the other big tech companies, we will have to wait till the following week where Microsoft, Meta, Amazon, and Apple will report their quarterly performances. As for Nvidia, their earnings will only be out towards the end of August. Okay, apart from a slew of earnings this week, the market will also be zooming in on the Fed's preferred inflation gauge, which is the PCE index, set to be released on Friday, 26 July. If it comes in favorably, it will help to keep the expectation of a September rate cut alive. Alright, moving over to the technical analysis segment. For SPY, which represents the broader market, its movement for these 2 weeks will be largely affected by the earnings of the mega cap companies. If most of the earnings disappoint, I think there is a very high possibility for SPY to hit 541 level. This is a level where SPY was consolidating above for about 11 trading days not too long ago. If this breaks, don't worry. But if the next key level breaks, then the bulls should be worried. The next so-called important level is 535. If SPY goes below this level, it means it has broken below the critical 61.8 Fibonacci level, the 50 moving average, and the bottom of this gap. When that happens, the market would have turned bearish, and the bearish momentum could continue in my opinion. I wouldn't be surprised if it falls further towards the 100 moving average at around 524. From the current price to 524, that's about 4.5% pullback, which is very healthy actually, and give investors some opportunities to buy discounted shares. On the other hand, if various megacap companies report solid quarterly results and outlooks, SPY could easily reclaim 554, where the 23.6 Fibonacci level is. And it will unlikely stop here, as I am of the view that it will at least fill the small gap between 560 and 562. From there, I think it's just a matter of time for SPY to hit another all-time high. Anyway, because the various megacap earnings spread across 2 weeks, whatever I have painted earlier should be looked at based on at least 2 weeks timeline. Let's now check out Apple's chart. Apple went above the 100% Fibonacci extension level briefly last week, but it got rejected and started its retracement. At the current level, watch for the 50% Fibonacci support at around 222. Apple bounced off that level last Thursday and went near it on Friday, so watch this level carefully this week. If it breaks, then obviously the next Fibonacci support level will come into picture, which is 218. If you have followed me long enough, you will probably know that this 61.8 Fibonacci level is quite important. If it breaks, I would say Apple is quite bearish, and Apple will fall back into this mini consolidation area that ranges from 206 to 218, which also means there is some possibility for it to grind towards the bottom end of this consolidation zone, which is below 210. Below 210, pay very special attention to 206. Other than being the 100% Fibonacci retracement level, it is also where the 50 moving average sits. Apple has not been trading below this moving average since it gapped up back in May this year. Therefore, by falling below it, it is very bearish. Well, in terms of the upside, it's pretty straightforward. Apple has to reclaim the 2 Fibonacci levels that it has lost to resume its bullish momentum. Anything below these 2 levels, 230 and 225, I wouldn't go bullish on Apple. But if Apple can fill that tiny gap between 231 and 232 and don't get rejected, there is then a high chance to create another new all-time high, and that is when sellers will dry up. For this to happen, Apple's earnings and forecasts have to impress investors. I'm not very confident it will, but I could be wrong. Let's see. Alright, let's now have a look at Tesla's chart. In my previous video, I shared that I was of the view that short sellers might have been covering their positions, which have resulted to the recent parabolic run-up. And when everyone is done covering their positions, the run-up should run out of steam. A look at the volume chart shows that the daily trading volume has been above average during the run-up, but last week we saw the volume declining. It could be a sign that shorts are more or less done covering their positions. But I must caveat that this is just a guess from me. Do take it with a tablespoon of salt. But what is considered a fact is that the volume is indeed dropping, which means there is a bit of buyer's exhaustion. On top of that, we just had a bearish cross on the MACD, and price action wise, it has been creating higher lows for the entire of last week, as indicated by that blue trend line. So if this is a sign of near-term bearish momentum, then I would expect Tesla to retest the purple downtrend line, which is in the 220s range. If Tesla goes below it, it's even more bearish. When that happens, I will skip the 50% Fibonacci level because of how volatile Tesla is. In other words, below that trend line, it's almost quite high probability that the 50% Fibonacci level will get breached as well. The critical level actually lies at the usual 61.8 Fibonacci level. In fact, this level is even more important now when the 200 moving average is also sitting right here at around 205. Alright, I think this video is getting longer, so I will keep this short. If you had found my video useful so far, do help me like, subscribe, share and comment something below. That will help to boost the YouTube algorithm. You may also consider buying me a YouTube super thank or a cup of coffee via my Ko-Fi link. Okay, back to business. Despite the bearish price action and bearish MACD cross, and with all that great candles, I have to say, earnings is always a wild card. Remember during the last earnings when everyone was so bearish, but Elon Musk came out to excite investors and Tesla popped 12% post earnings. Therefore, don't rule out the upside yet. So in terms of the upside, watch out for 246 and that blue trend line. If Tesla can break above it, it means the short-term downtrend is gone, and given how volatile Tesla can be post-earnings, it may charge towards 270s if it can reclaim 246 decisively with volume. Lastly, let's have a look at the expected move for Tesla's share price post-earnings. According to Options AI, it's about 8.7%. And check out the past 4 post-earnings movements. If you were to average them out, it's about 10.5%. So let's say we use 10% to calculate. It means from the current price, Tesla will either head towards 260s range or it will fall towards 210s range. Nothing is guaranteed here, of course, but given its track record for huge movement, you may want to stay out of it before earnings. Grab some popcorns and watch how the share price moves after its earnings. Let's now move over to Google. In my previous video, I specifically highlighted 4 bearish signals, and the bearish thesis really played out. You can check out my last video if you haven't. Anyway, I also mentioned that Google could potentially head towards the middle of the uptrend channel with 180 in sight, and it did. In fact, it went below 180. So what's next? Below 180, there are 2 key levels to watch, which was also covered in my last video, and they are 177 and 173. Like I have shared, before Google report its earnings, this area is a potential bounce area, and well, check out the chart. Google bounced off 177 last Thursday and Friday as the market sold off. This simply shows that this 177 level offers a decent support, likely because this is where the 50% Fibonacci level and the 50 moving average are. And even if this breaks, 173 is yet another strong level, because this is where the critical 61.8 Fibonacci level and the bottom of this uptrend channel converge. Just to add, we have not touched the bottom of this channel since April this year. But things could change this week with earnings day coming up on 23rd July. So watch the 2 levels closely. If they break, and because they are strong support, it means Google is pretty bearish. In short, you wouldn't want strong support levels to get breached, because when they do, it usually means waterfall, and more downside could follow. And I'm talking about below 165 kind of level. Not saying it will happen, but if 173 and 177 break, the possibility would be quite high. In terms of the upside, if investors like their earnings and forecasts, I think Google will easily reclaim the middle channel line and the 38.2 Fibonacci level at around 180. In fact, solid results will offer a high probability for Google to charge towards the top end of the channel, which is around 190. And at 190, what does it mean? It means we are almost certain to create another all-time high. Okay, as mentioned earlier, it's difficult to predict which direction it will go post-earnings, so just watch the various key levels. When they get breached, it tends to open up more doors and possibilities. Moving over to Meta, just like my last video, I will break the chart down into 2 consolidation zones, which you can see on the screen. Obviously, Meta has broken below the top consolidation zone and entered the bottom one. And as shared in my last video, I would consider stepping in for Meta if it falls last week, which I did. More on that later in the end thoughts segment. Anyway, Meta's earnings is next week, so I would expect Meta to move within these consolidation areas in the meantime. But if we want to be more detailed, watch for 488 for the upside. This is one strong resistance level at the moment, because it is where the 61.8 Fibonacci level is, as well as where both the 50 and 100 moving averages are. Actually, Meta tried going above last Friday but failed to do so. Therefore, for Meta to resume its bullish momentum, it needs to reclaim this level decisively. If that happens, then it will open up the path towards 500 level and possibly the top end of the top consolidation zone. On the other hand, if it couldn't get above 488, we may see 460s and 450s range again, something like what we saw last week. As long as it stays within this bottom consolidation zone, we are good. But for whichever reason this week, or if earnings disappoint next week and Meta drops below 450, I think it will open up the possibility of hitting the 200 moving average, which currently sits at 425. Finally, let's move over to Microsoft. So in my last video, I shared about a bearish cross on the MACD and there was some chance for a pullback to continue. Well, I wouldn't dare to say I was able to predict last Friday's IT outage, but on Monday to Thursday, Microsoft did actually pull back. I also shared that it will at least hit 444 level, and it did so as well. In fact, it went below that. And then I also mentioned that it is quite unlikely for Microsoft to fall below the 50% Fibonacci level at 436 before earnings. And guess what? Despite Friday's IT outage and Microsoft moved below 436 during intraday, it did recover and closed above 436. I hope this analysis can warrant a like button from you. Anyway, for this week, the 436 level remains important. Not only it is where the 50% Fibonacci level is, the 50 moving average is around this level as well. In fact, pay close attention to this 50 moving average. Reason being, since Microsoft embarked on this super bull run that started in September 2023, so far Microsoft has reacted quite positively when it went near or slightly below the moving average, except for April this year, where it traded below it for about a month, but it still recovered. So looking at today's context, don't be alarmed if we fall below it again, but it should not trade below it for too long. The longer it stays below it, the more bearish it is. Anyway, below the 50 moving average, watch out for the critical 61.8 Fibonacci level at 428, or maybe give and take a little bit to 425, where the 100 moving average is. If Microsoft goes below both moving averages these 2 weeks, I would say low 400s could come into picture, or at least 415. As for the upside, see that little gap there? It's between 444 to 446. Microsoft needs to fill that gap and stays above it. I will only dare to say Microsoft is bullish if it can also reclaim the 453 level, and I think we need solid earnings from the company to go above this level. In fact, if earnings can drive Microsoft above 453, another all-time high could be in the picture. Moving over to the options trading section, the first trade to update is this cash secured put on Nvidia that was sold on 17 July Wednesday. The strike price is $95, expiring 30th August. What happened on that day was that major chip stocks fell after US President Joe Biden reportedly plans to impose more trade restrictions on sales to China. Specifically, Nvidia dropped 6.6% on that day, and if you have followed my channel long enough, you may have guessed the reason behind my trade. Well, yes, the reason is because of the overreaction by the market. Honestly, just because of this news, Nvidia gapped down and fell more than 6%. I thought that was a little too much, considering the demand for its chips are still very strong. Even if the restrictions will affect their sales, my view is that it hasn't been confirmed yet. And even if it has been confirmed, it hasn't been executed yet. Nvidia's sales for the rest of 2024 will remain solid in my opinion. So yeah, with every overreaction to the downside, it's almost certain there will be a rebound. We have seen this a lot of times, and I have also covered them on this channel. And so I stepped in to sell that put contract, which is a slightly bullish move. Well, guess what? Nvidia rebounded the next day by rising 2.6%. I could have exited if I had wanted to, but I didn't because I don't mind holding on to this contract since Nvidia's earnings day is about a month away, which could swing the stock wildly in either direction. So that risk is out of the equation for now. In the near term, before the earnings, I really think this overreaction to the downside is a little too much. So anyway, Nvidia did retrace again on Friday, and the trade is sitting on a paper loss, but it doesn't really concern me. Honestly, even if Nvidia falls below my $95 strike price on expiration date, I wouldn't mind buying the shares at $95 each. I mean, if you were to ask anyone whether they will buy Nvidia shares if it drops below 100 now, I think many will probably say yes. Okay, the next trade to update is this day trade or scalping on cash secure put on Nvidia. Before I go on, I just wanted to say the profit for this trade is only about $25. So if this profit amount is a little too small to interest you, feel free to skip this segment. I am sharing because I want to be transparent and open about my trades. Anyway, on 18 July, one day after the market had overreacted to the news on semiconductor and chips industry, I was of the view that Nvidia will be due for a rebound after falling by more than 6% out of nowhere. On that day, Nvidia popped at the opening but faded about an hour later, which you can see on this 1 minute intraday chart. Then at 10:49 PM Singapore time, I saw the chart printed a few solid green candles consecutively and MACD was having a bullish cross. This means that a bounce was likely to come. I then quickly sold a cash secured put, which is a slightly bullish move. The premium that I received was $282. My plan was to exit quickly because you never know, the decline may continue on the second day and the bounce could come later. Therefore, I told myself, don't be greedy, just aim to earn about $20 to $30 for my lunch the next day and I'm good. But unfortunately, I wasn't able to exit during the bounce right after I sold my contract and Nvidia fell back down again. So what I did was to place a limit buy order of $2.57 and then at around 11:30 PM, Nvidia started to rebound again. This time round, the bounce was pretty solid as it continued all the way to 1:30 AM. In the process, my buy order was filled and I managed to exit the trade. Again, the total profit isn't a lot, about $20-ish, but I will take it anytime to cover my next day's lunch. Actually, it was more than enough to cover that one lunch. Okay, finally, the last option trade to update is this cash secured put on Google, which was sold on 18 July, Thursday. The strike price is $160, expiring 30th August. Okay, as mentioned in the earlier technical analysis segment, I have spotted 4 bearish signals on Google's chart in my last video, and the bearish thesis really played out. I also shared that even if the share price falls on the bearish signals, it is quite unlikely for Google to go below 173 to 177 area. And Google really bounced off 177 as shared earlier, as the 50% Fibonacci support level and the 50 moving average combined together to offer a decent support. Quick recap from the earlier technical analysis segment, below 177, 173 is yet another strong level because of the critical 61.8 Fibonacci level and the bottom of this uptrend channel. Okay, here comes the tricky part. Earnings is coming up and earnings is always a wild card because it can make the share price swing either direction wildly. And therefore, should I close my position early this week and take whatever profits I have? Or should I hold on to it since I have quite a bit of buffer in terms of the strike price? I mean, I had the earlier 2 strong support levels, and furthermore, my strike price of 160 is even below the 100% Fibonacci retracement level. Well, let me think about it, but from the bigger picture, if I were to get a sign, buying Google shares at 160 per share doesn't seem too bad, isn't it? Alright, as mentioned at the start of the video, we have seen a rotation of money out of mega cap winners over the last 2 weeks. Is this something we should be worried about? In my view, not at all. The current shift towards smaller cap companies which have been viewed as bigger beneficiaries of interest rate cuts is healthy. In fact, I think the current rotation is long overdue. Because at one point, some investors were a little worried that the rally was becoming too dependent and too reliant and concentrated on a small handful of mega cap tech stocks. And when they falter, that could be a huge decline. Currently, the pullback in this small basket of stocks looks pretty healthy for now. Note the word for now. This is because their upcoming earnings will be key in deciding their fate. It's as simple as if they deliver, then some money may go back to some of these individual tech stocks because FOMO and buy the dip crowd may step in. But of course, if they fail to deliver, the current rotation will likely get worse for these big tech companies. This is not a rocket science. Okay, to me, even if the latter happens, say there is a much bigger sell-off in the tech industry than what we saw last week, I wouldn't be too worried. In fact, I would be excited to pick up some shares. Speaking of this, I stepped in for Meta last week when it went below 470. Though it has gone up above my buy price as of last Friday, if Meta's earnings disappoint, it will fall below the price that I bought, but I am okay with it. Reason is because I know it's not possible to pick the bottom, so if Meta falls to say the 450s range or even lower, I may step in again to pick up more shares. And this is the same for any other stocks that I am eyeing. As mentioned in my past videos, I am generally quite positive about the economy and the stock market for the second half of this year as inflation improves and the market rally broadens out to other sectors and the smaller cap companies. But of course, it will be a different story if some black swan events happen. In fact, last Friday's IT outage is one good example of a black swan event. Imagine you are holding on to CrowdStrike stock, and because of an update to an antivirus program, it caused a massive global IT outage, and your stock tanked more than 10% in one day. Okay, before I end this video, just one more important thing to highlight. As the date for US presidential election gets nearer, expect more volatility in the market, as both presidential candidates start making their stance, views, opinions and whatnot. For instance, we saw the chips industry experiencing a sell-off after reports said that President Biden plans to tighten China curbs. And then we have the former President Trump pledging to remove the national EV mandate. He also welcomes the Chinese EV makers to set up factories in the US, which would be a big shift from President Biden's position. All these news have affected the share prices of chips and EV makers. To add on, VIX index, a matrix to measure market fear and volatility, has spiked more than 40% in the last 3 weeks. This means volatility is back and is likely to stay with big tech earnings coming up and the two candidates coming out with their speeches to try to win votes. Okay, it has been quite a long video, thanks for watching, and do help me in reaching out to more viewers by tapping on the like and subscribe buttons. Thank you.